Great. Good morning, everyone. Welcome to another one of our Thursday calls. This week, as we often have, we've got Pierre Miller to talk about FirstRand. So over to you, Pierre.
Thanks, Vaughan. Good morning, everyone. Thanks for joining us on the company update of FirstRand. FirstRand has a June year end, so we'll be looking at its 2024 financial year results more specifically today. Just starting on a macro environment overview. So the expectation is for lower interest rates and inflation. This should bode well for the consumer financial health. And then just to summarize some of our main takeaways from the results. The earnings benefited from net interest income growth. That was mainly due to the loan growth and not, say, the net interest margin expanding. And this was set off by elevated expenses, which was caused mainly by they made a provision for the UK FCA that's doing an investigation into motor commission practices on that front. So the expenses was elevated due to this provision. And the other takeaway that we have is also the outlook that we see as an improved outlook. So we just touch on a couple of lines there in this outlook. So starting off with net interest income, we feel management was a bit conservative in the net interest income guidance. So in the guidance, they don't give specific percentages of growth. They just said the growth will be slower than this year for net interest income, and stating that they're going to shift more towards commercial and corporate lending, which has lower margins, before they deploy more capital into the retail side, because they first want to see that the consumer health is improving because of low inflation and interest rates. So as we expect the consumer health to benefit, we see management might upgrade this guidance once the interest rates does decrease and you start seeing that filter through to the consumer health. So we, first of all, on the net interest income, we see a potential upside compared to what management guided. And then on the non-interest revenue, management guided growth there, but they also guided growth on items such as your private equity realization. So when they sell some of their investments, these things are usually hard to forecast. So that's positive to receive positive guidance on something that's a bit trickier to forecast. And then on the expenses, because it's elevated at the moment with the provision that they made, they mainly just guided that the profitability ratios will improve, such as your cost to income. So we expect profitability to improve as they guide. And then they also said that the credit loss ratios on the payment front will go slightly higher, but should still remain below the midpoint of their through the cycle guidance for the credit loss ratio. So it is expected to increase as they are at a very low point at the moment. So we don't see, it's nice to hear that there's not a higher risk that they see coming on that from that front. Then if we turn our attention to the valuation. So if you were to look at the 5-year averages, FirstRand does look a bit more expensive. But then you have to consider that in the past 5 years, we have seen things such as COVID, increased load shedding. As the interest rates increased, the world has been a bit more of a risk-off approach, so less capital flowing to emerging markets, your higher type of risk environments. So it was quite a low sentiment in the past 5 years. So I would rather align it to a 10-year average. And if you look at a 10-year average PE ratios, FirstRand is still slightly below the average on that front. So we still will see some upside on that front. We maintain our buy recommendation. And what would change our mind, so these are not things that we're expecting, but would change our mind is if the profitability ratios decrease. So FirstRand has higher return on equity, and so then other banking peers. So if that were to decrease, they don't have, let's say, that edge or so that would change our minds. And then if the interest rates were to increase, because FirstRand manages its net interest margin, so other peers would receive a larger benefit from higher interest rates. And also if the SA outlook deteriorates, because FirstRand has a higher exposure to South Africa compared to some of its peers. Looking at the results, if we just start on a higher level, so the total revenue increased by 9%. This was less than the expenses, which increased 11%. That translated into lower profitability ratios, such as your return on equity decreasing slightly, your cost to income increasing slightly as well. And then if we just touch a bit more in the detail there, the net interest income, you can see is up 9%. So the net interest margin, so how much they earn from the assets, that stayed flat. But the total assets, the average interest earning assets, that was up 9%. So they made good advances growth on that front. The non-interest revenue is mainly driven by net commission and fees, which increased. And then there were other lines, insurance was up, and then also the joint ventures and associate investments that also increased. And while we're on that front, so the graph at the bottom right, apologies for the very small figures, it's hard to see, but the main thing that I want to focus your attention on is the orange line. So that represents the unrealized value of their investments in their private equity. So they, as they guided, they have a strong pipeline for more profit realizations. You can also see it in this graph that they have a good set of unrealized value that's possible for them to realize going forward, which, as mentioned, it's a bit more once-off impacts and hard to forecast. The darker side of those bars are the annuity type of income that they receive, and you can see that's also trending in a more steadily fashion upwards. Expenses was elevated due to that provision, as mentioned, and then the impairment charge grew by 14.7%. So considering that the assets increased, that would also lead to your provisions increase. So that would drive your impairment charge on a natural basis to increase. And then they also, as they were quite low compared to the history on their range, so they target through the cycle range of 80 basis points to 110. Credit loss ratio, you can see how they actually, in the prior year, they were below this range. So almost taking too little risk in a way. So it's 78 basis points, and now it's going back into the range, but still at the very low end. So you can just see that those metrics ticking up slightly, but no concern there yet that we see. The following waterfall graph, it just visually shows you most of the things that we just discussed, but you can see there the net interest income being the largest green bar, so the main thing that contributed to the profits. That's due to loan growth. And then the largest detractor there is the provision that they've made. Then looking more specifically at the non-interest revenue, as I mentioned, the net fee and commission income is the largest portion, 69%, and that was up 5%. So that would be the largest driver of growth. Another large driver was also the share of profit of associates and joint ventures. This is just businesses where there are all smaller stakes, so it's not consolidated into the business, but those profits were also up at these smaller businesses. At the operating expenses, you can see staff costs for most banks, that's the largest item. So the staff costs for FirstRand representing 60% of their expenses, that increased 5%. And that's mainly due to the average annual increases being around 6%. Computer expenses also increased by 13%, and they stated that that's due to the currency impacts and increased software licensing costs. And then most notably as well, the UK motor commission matter, there was 3.3 billion. 3 billion was the provision, and about 300 million was due to the legal fees that they're paying in this regard. Looking at the share price performance, so the graph at the bottom is a 3-year period. You can see FirstRand outperformed, and if you look at the table at the top, that outperformance was mainly in the past 2 years. On a valuation front, you'll see over this 5-year PE chart, it's a bit at the higher end at the moment, but I'm not showing now the 10-year, but if you were to look at a 10-year, it would have been slightly below the average. We have an intrinsic value, however, for FirstRand at 97, so we see both a little bit of upside coming from the PE ratio, which we could say can go a bit higher compared to the 10-year averages and so that we've seen, and we've also see earnings growth. So earnings growth is also going to potentially drive the share price, or that's also in our intrinsic value. That brings me to the end of my side of the presentation, where Sean can do the technicals for us now.
Yeah, good morning, everybody. You can see the chart there of FirstRand. This is, again, yesterday's close. The share price is trading below its 20 and 50-day moving averages, but it's still trading far above its 200-day moving average. That's that yellow line at the bottom there. So the long-term trend remains bullish, but the medium-term trend seems like it's changing to bearish, with the 20-day moving average crossing below its 50-day moving average. In the short term, you can see there the share price yesterday crossed below, or closed below, the what I call the previous resistance support zone between 81.90 and 80.33. So today I see the share price has bounced back a bit. Last was trading up 1.7%, so it's hovering around about that, just below that zone. So we could, on the one hand, expect it to move back, or alternatively move further back on some profit taking to that longer term resistance, again, support zone between 76.48 and 74.63. The reason I'm saying that is the MACD indicator is trading below, or is trading in oversold territory. That's what they indicate at the bottom there, and it's below its trigger line, which is a bearish signal. And as Pierre said, now the share price is trading far below its intrinsic value of 97, and hence our buy recommendation. So at current levels, this is still more than about a 22% upside potential. That's how I see it. Thank you.
Great, thanks, Sean. Thanks, Pierre. We're open to questions, and I just see in the chat, Brajesh is asking a question for you, Pierre. What is the period you will hold the share to gain the projected intrinsic value?
Yeah, so we do think about investments, compared to, like, let's say the technical charts, a bit of a longer period to realize, but the expectation a year to 2 years, because I think that's how I also see the momentum playing out on the positive outlook of South Africa. As the, let's say, less load shedding, that still filters through eventually to manufacturing and all of that, and all of that filters through to all the kind of indexes and things that we see, and as they release those results, that has a positive view on South Africa. So there's what I'm saying is a bit of a delay effect as well. So we're already starting to see improvements, but let's say as these improvements happen, maybe over the next year, there's a bit of a delay effect, how the data filters through, and then you still see further upside. Yeah, so that, I would say about a year.
Right, thanks, Pierre. Is there any other questions for Pierre? Okay, Sivu, do you want to go for it?
Yeah, thanks, Sean. I just wanted to check, because that with that intrinsic value, I mean, sitting at 90, at about 90 something, I think it was 92 or 97. I'm not sure about the exact figure, but one would be curious, for instance, if what is there any way maybe to project that, if it's something that can either go down or go up?
Yeah, so it's intrinsic value. So let's say no one can predict exactly where the share price will be. So you have your type of views of risks and things where you see it. So that's just us saying I think this is where it's a fair value for FirstRand. So we can't say exactly it's gonna be 97, at the end of April next year or something.
Yeah. I was just asking that because I think I saw somewhere where they had a bit of a lower value, and I mean which it was even lower than the current share price. And I mean to your point that you raised earlier, that it's how one views it based on his on the facts that he's got at hand. So I think to your point, I mean it's a question of the better the research you do, the better you can have the more accurate can be your intrinsic value.
Also,
100%.
maybe just to add to what Pierre said, Sivu, is that for a company like this with the ROEs that you've got, which is well above its cost of capital, you would expect over time that intrinsic value to grow as the future discounts back. So as we go to next year, because they're creating value, you would expect those intrinsic values to grow over time for a company which is beating its cost of capital like that this one is.
Yeah.
So that's sort of how it works.
All right.
Yeah,
Thank you.
and I think also maybe just to talk to how I value first, and so I think you're talking about how we got to that intrinsic value. So we do a forecast what we expect the earnings will be, and that would take into consideration, how we view the net interest income growing and the expenses and all of that. That would give us eventually a profit and earnings per share, and then we also apply a PE ratio, which we think is fair for FirstRand, given the current environment and the growth outlook. And then that eventually gives us an intrinsic value per share. So there's quite a whole mixture of science and a bit of art involved in that.
Thanks, Pierre. I've got a question on the chat from Frederick. You prefer ABSA over Standard Bank. Does that also apply to FirstRand? Thank you.
It does. So a large view that they both share, both FirstRand and ABSA, why we prefer them to Standard Bank. If you were to look at the interest rate sensitivity, so that would basically be your net interest margin, how the net interest margin will move up as the interest rates move up. So if you look at that relationship, Standard Bank has quite a sensitive one. So Standard Bank benefited quite a lot now in its earnings from the higher interest rates environment. ABSA and FirstRand didn't benefit. Their net interest income also went up with the other banks, but that's because they actually grew their assets, so their advances. So how does that play into our preference? So we're thinking forward now that the interest rates are going to go down, and then ABSA and FirstRand has steady net interest margin, so it's not going to go down like on Standard Bank. We think the net interest margin is going to face pressure as the interest rates decrease. We don't think necessarily that Standard Bank will that the net interest income in totality would decrease because they're going to get loan growth. So as the environment is less risky, they're able to deploy more capital. They don't have to hold back. So they're going to get loan growth, but the loan growth is going to be offset by a lower net interest margin, so earning less interest from those assets. So we think ABSA and FirstRand is going to get a benefit compared to Standard Bank on that side.
Brilliant. Thanks very much, Pierre. Nice and clear. Are there any other questions from anyone? I'm looking in the chat and I'm not seeing any hands. So last chance. Boom, I'm not seeing anything. Okay, I think we've got it all there. Thank you very much, everyone. Have a great week, and we look forward to hosting you next week again. Cheerio.